Good afternoon, members. My name is Anthony Rodwell Ball and I'm Chief Executive of NGS Super. And welcome to this, the first of the 2012 video updates. I'd like to especially welcome members of Uniting Church Super who joined us on the 1st of March. Any of you are watching, we commit to providing to you the same level of service and hopefully the positive investment returns that we've delivered to our NGS members over the last 23 years that we've been in existence. We're delighted to have the association and we will commit to working to bring about the best possible retirement incomes that we can for you as a constituency, as we do for the rest of our members. And now to business. The NGS Board and its various committees have met again in February. The Investment Committee conducted a 1.5-day strategy review in the middle of the month, and the board convened at the end of the month for its own strategy review. The issues that were covered in those meetings focused on asset allocation, risk, time horizon and return objectives, and a work plan for the 2012-2013 period. As you might well expect, the board continues to be very focused indeed on the investment climate. Market sentiment appears to have improved over the last 3 months. The so-called Santa rally that started before Christmas has been sustained so far in 2012. Leading economic indicators out of the United States have been better than expected. Unemployment is trending downwards in the States. Consumer spending is recovering modestly. Manufacturing indices are moving positively. The VIX, or volatility index, is down, close to pre-GFC levels, and a leading indicator of possible market trends over the next few months. Corporate balance sheets and reported earnings are remaining by and large strong. The result of all of this is that there's been a strong bull market since before Christmas, with other markets reacting largely in tandem. It should also be pointed out that economic news coming out of China has been better than expected. It appears that they'll have a soft rather than a hard landing. And of course, with our exposure to Chinese markets in Australia, that is good news indeed. The impact on the world at large, however, should not be discounted by Chinese economic activity, as we know. But the smoky in all of this is, of course, Europe. A debt deal has been done with Greece. But arguably, questionably, is it a permanent fix? There are concerns continuing about Spain and Italy. The European Central Bank is printing and lending money to ensure liquidity and the effectiveness of the European banks. But a question is begged in all of this. How does the mountain of debt get repaid? Our view is that there's a deliberate gamble being undertaken on a strategy described as financial repression, which works as follows. Firstly, you print money and allow debt to deal with the liquidity in the economy to keep the banks in capital. Secondly, you keep interest rates at record low levels, currently 1 to 2%. You then allow moderate inflation to run its course, and by moderate I mean something in the range of 3 to 5%. So in time, the impact of these various influences means that the difference between inflation and interest rates reduces the overall debt, and debt is paid off in the future with money which is worth less than it is today, obviously because of the inflation effect. I would point out that this technique was successfully employed in South American economies in the 1980s, but never attempted before on the massive scale that's being undertaken in Europe. And therein, of course, lies the risk. The question is still unanswered. What of Greece, which may still default? Well, Greece's economy is smaller than New South Wales's, slightly larger than Victoria's. And without being facetious, would international markets really react if New South Wales defaulted? Probably not. If the European Central Bank and other regulators manage to ring-fence the Greek debt issue, devise a mechanism whereby Greece refloats the drachma as its own currency, and then defaults in an orderly fashion, the contagion will be contained. Greece's economy is tiny and shrinking anyway. In the context of Greece, it's worth remembering that Argentina defaulted in the early 2000s, And today, some 10 years later, with a comparatively weaker economy, but importantly, with a weaker currency, Argentina is competitive again and growing fast, albeit with some challenges. So in conclusion, the NGS board believes that its current strategy for the diversified option is still appropriate. The option has returned an estimated 4.04% for the last quarter and minus 0.08% for the year to date. In other words, very close to getting into positive territory. So the board's conclusion is that economic indicators currently are on the upside and the strategy should remain very much in place. The board meets again in early April, and I look forward to providing you with an opportunity at that time for a further update. Thanks for listening.